Let's bring in Kevin Green, who joins me now. We've got the US leading index data that was just released. What are you seeing there, Kevin? Good morning to you.
Good morning, Sam. Yeah, well, when you're seeing the index here, we actually saw that number coming in at negative 0.5% for the month-over-month change here. And the August data set did show or flash a recessionary signal, which sounds a little bit scary, but it's been doing that for the leading indicators index for a considerable amount of time here. And they really blame non-financial factors for the decline for the month, as well as the yield spread, if you will, continuing to widen out, which is kind of a signal in some respects of tightening financial conditions. So this has been an indicator that's been, for the most part, in a downtrend if you're looking at the nominal index level. But the recessionary signals, let's say that they have been flashing for a fairly long time, but we have not seen that come to realization as of yet when it comes to the hard data. So that's what we're seeing with that index. It used to carry a little bit more weight. It used to be a little bit more of a mover when it comes to the equity markets, but it seems like over the last couple of months that has abated.
Okay, as I mentioned, we got some other economic updates this morning by the way of the Philly Fed, which looked good because we saw quite a huge jump there from that negative reading we got the previous month. Also, jobless claims are much better numbers and perhaps a relief for the job market. So what are your takeaways? I mean, I suppose that helps build the case for what we got from Powell and Co. yesterday.
Yeah, well, when you're looking at the regional Fed surveys or these, the Philly Fed Index, or if you're looking at the Empire State, we also have to kind of note that these are purchasing manager sentiment data, not really hard data. And so it can actually flash some really aggressive signals, both bullish or bearish at times. And I think the market is taking it with a little bit of a grain of salt. But this has been a really good report, as you talked about, a nice little re-rating to the upside. When you're looking at the headline index number, that came in at 23.2. Street was looking for around 1.7. But the prices paid index, or that component, is really the headline mover. We did see an aggressive movement to the downside when it comes to prices paid, not only just paid, but also received as well. The reason for that adjustment or the re-rating to the downside is companies are reporting that they're not seeing additional price increases. The prices are still remaining elevated, but you're not seeing an increase. So that actually gave us a little bit of a decent move to the downside when it comes to that index. And sometimes these can be leading indicators. What you would like to see is the Philly Fed Index, the Empire State Index really starting to match the ISM Services prices paid index. If that's going to be the case, because that's a really good leading indicator, then maybe we do see a softening when it comes to inflation in the future. Sometimes it could take a considerable amount of time for that to really show up and reflect here. And then you also have initial claims. That actually came in lower than the Street's expectations, coming in at 231,000 for the week. Street was looking for 241,000. We've been kind of talking about the fact that Texas had a really aggressive increase last week. They did acknowledge that there was some significant amount of fraud claims that were being processed or were caught. And we did see a little bit of a readjustment when it came to this week here. So you are seeing yields moving a little bit higher. Dollars also moving higher here. We have equities higher. That's something that we haven't seen in a very long time. It seems like the market's okay with that for now, but the economic data, at least for today, looks a lot better than what we saw 24 hours ago leading into the Fed's decision when it came to the rate cuts.
Okay, and the Fed isn't the only one in the spotlight. Jumping across the pond now, Kevin, we've also seen the BOE actually standing pat on their rates at 4%. Andrew Bailey, the governor over there, saying that they're not out of the woods yet. They are worried about the upside risk to inflation there. You and I were discussing that yesterday. Just wondering what your overall takeaways are here. And what I found really interesting, particularly because we've been keeping an eye on the long end of the yield in the UK, is that they're actually going to slow down the pace of that QT now. Just wondering your reaction and also your assessment of what we're seeing as far as the movement in the pound, which is not moving too much, but just your overall takeaways there.
Yeah, I mean, this isn't surprising. We talked about the rate of inflation, CPI, for the UK yesterday, continuing to be fairly elevated, especially on the food front, as well as when you're looking at wages. Now, the UK is also experiencing growth when it comes to GDP, maybe not as aggressive as they would like to see, but they do have some stickiness when it comes to inflation, at least for now. So they did keep rates where they are at. And when you're actually looking at the vote, 7 members actually voted for unchanged rates, which is obviously the prevailing decision. And you had 2 members actually vote to cut rates. rates. The easing of monetary tightening, Sam, is also probably a little bit more strategic. We do know that the UK is going to announce a pretty big deal when it comes to their budget in November, and we kind of remember what happened in I believe it's 2022, if I'm not mistaken, where we actually had the UK budget that was really aggressive. There was the Starmer, type of moment. We did see yields aggressively re-rate to the upside, and there was kind of some political backlash. So trying to ease maybe some of the risk of that tension leading up to that budget announcement is probably another reason why you're going to see maybe a readjustment when it comes to the tightening policy on the long end of the curve there.
Yes, I think it was referred to as the Liz Truss letters at that time. Just switching gears back to here, let's talk about the charts that you're looking at and stocks that stand out for the S&P 500 right now as we've hit a fresh record this morning.
Yeah, a couple of charts that I'm actually looking at here. If you're looking at the S&P 500 in the longer term time frame, I have a 20-year monthly chart. We are actually approaching a key area of resistance, and this trend line actually has been in place since around 2016 or so. So you're talking about 9.5 years, let's say 10 years. And this has been a key area of resistance that we are pretty much testing as we speak. So I'm actually curious to see how the market's actually going to be resolving this. If you kind of look at the RSI on the monthly chart, it's still making lower highs at this point. MACD is actually in a bullish formation, and the NYSE advanced decline is actually still kind of sloping to the downside a tad bit here. So we do know that September, for the most part, has actually done a phenomenal job kind of going against the grain when it comes to seasonality. We do have options expiration tomorrow. We will have an adjustment when it comes to options positioning across the board for equities, for indexes, as well as for futures as well. And that could also bring in a little bit of volatility and also could dry up liquidity over the next couple of trading sessions. We've done a phenomenal job, but let's see if we actually break out of this channel. Once again, this has been intact for about 10 years. We actually have a pretty decent breakout over the next couple of months. You could talk about a massive re-rating to the upside here. If you are a technical trader, you are getting a little bit cautious at these particular levels though, Sam, and that could be leading to maybe a small pullback, small correction before trying to move higher.
Okay, we'll be watching, certainly flying in the face for now of that seasonality, as you mentioned, Kevin. Thank you so much for breaking that all down. Really appreciate your time, Kevin Green.